Hello and welcome, everyone. I'm Amy Miller, Director of America Saves. I want to thank you so much for joining us for today's webinar, From Saving to Closing, Making Home Ownership Feel Possible. We're very excited to partner with the Homeownership Council of America to talk about practical steps people can take towards home ownership and some of the resources that make that journey feel a little bit more achievable. For many people, housing is one of the biggest financial goals they'll ever work toward. Home ownership can represent independence, stability, and an opportunity to build long-term wealth. But for many of us, it can also feel overwhelming or even a little out of reach. Common barriers and misconceptions like feeling you'll never save enough for a down payment, or believing that you need perfect credit, or assuming that you simply just can't afford to buy a home leave many of us feeling like, home ownership just isn't realistic. And while today's housing market certainly presents its challenges, many people are surprised to learn that there are programs, tools, and strategies available that can help bridge the gap and make home ownership feel more possible and practical. And that's what we want to do here today. This webinar is about making home ownership feel possible and practical. Our goal isn't to pretend that buying a home is easy, but it is to make it feel a little more understandable and actionable. And we want you to leave today knowing, what steps you can take, what resources exist, and maybe where to get started. Now, at America Saves, we focus on helping people build the habits and financial foundation that support long-term goals like home ownership. That foundation looks different for everyone, but it often includes setting realistic goals, understanding the cost involved, strengthening credit, managing your debt, and then creating a plan that's unique to your situation. The good news is that we want to remind everybody that you don't have to do everything at once. We truly believe that those small, consistent steps that are taken over time really do help build confidence and move you closer to your home ownership goal. And so again, I want to remind you all that the key is just to get started, stay focused, and knowing what resources are available to support you along the way. So I want to talk a minute about understanding the full cost of home ownership. As you're building that financial foundation, it's important to understand, what you're preparing for and saving for. When it comes to home ownership, it's about more than just that monthly mortgage payment. There are several upfront and ongoing costs that you need to consider. Things like down payments, closing costs, insurance, moving expenses, maintenance, and overall, affordability. For many, that cost can feel overwhelming and leave us wondering again, is this truly within reach for me? One of the biggest barriers when we hear from our savings that they talk about is that upfront cost of buying a home, especially the down payment. And so that is what we're going to be focusing on today. A resource that can help bridge that gap, which is down payment assistance programs. Many aspiring homeowners are actually surprised to learn that there are programs available that can help with upfront home buying cost, making home ownership, a little more accessible than you may have thought. And that is why we are so excited to be joined today by Gabe Ewing Del Rio, the CEO of the Homeownership Council of America. Gabe is a certified mortgage banker and affordable lending expert with decades of experience in housing counseling, mortgage lending, and down payment assistance programs focused on expanding access to home ownership for underserved communities. Through his work at HCA, Gabe has helped develop consumer-focused tools, education, and lending solutions designed to help bridge barriers to home ownership, including the Ready On platform that he'll be walking us through today that is all about home down payment assistance. So with that, I'm going to turn things over to Gabe to share more about HCA, down payment assistance, and resources that may help, home ownership feel a little more achievable. So Gabe, Thank you so much for being here with us today. Welcome. And I'm going to turn it over. The floor is yours.
Thank you, Amy. Thanks for having me. Excited to be here. One of the things I think we should mention right off the bat is you are focused on savings and we're talking about the barriers to homeownership that people face is the down payment itself. And one of the biggest myths that we see in homeownership is that you need to have 20% down. So while Amy just reviewed the upfront cost, that the down payment itself, additional funds for closing costs, having some additional savings set aside for moving and maintenance or other purchases you might want to make when you become a homeowner, that's kind of the structure for savings, but it's not 20%. So get that myth out of your head. If you were to wait and save the difference between what you need and having 20%, it would take a long time and you could be priced out. And so really the minimum amount of down payment to save up is 3% for the down payment piece. You would want to have another 2 or 3% of the purchase price for closing costs, and then maybe another five to $10,000 for moving and additional purchases. So that's the way to think about your savings goals. But the 20% myth really is a myth. You only need 3% down and 3.5%. That would be the conventional mortgages. So Fannie Mae, Freddie Mac, conventional mortgages available everywhere with every mortgage lender has a 97% mortgage program. So that means a 3% down payment and 97% first mortgage. That is a standard. FHA is at 96.5%, so it's 3.5% down payment and a 96.5% loan to value first mortgage. Just to think about making your down payment goals. The other thing, obviously here is that down payment we recognize is an obstacle, is difficult, is especially difficult for folks that do not have generational wealth, don't have someone in their family they could go to add to that pool that I was just describing earlier, what you'll want to put together for your first purchase. So what else is out there? What is down payment assistance? Down payment assistance is a wide set of programs. It turns out there are over 3,000. There's actually over 3,500 and counting. Different types of programs out there nationally, and they come in different forms. They are from nonprofits, from governments, that can be local government and state government, other housing authority sources, and then lenders themselves. And so these are kind of the main sources of these down payment assistance programs. They're mostly designed to help first-time home buyers get in to home ownership. There are also first generation homebuyer programs, veteran programs, and Native American programs to take a look at. And I'm going to share a tool that will help you find those a little bit later. First, I'm going to start off on what are all of these down payment assistance. Once you know DPA, as we like to say, down payment assistance is DPA, then there are different types that you're going to hear about or see when you begin looking at down payment assistance that's available. And so here's a quick list of what those types are. There are grants, forgivable loans, deferred loans, repayable loans, matched savings, and then self-help programs like Habitat for Humanity. So let me explain what these programs look like, and we're going to put a chart on the screen that we also have on the ReadyOwn app that you can reference anytime. So grants are something that is not repayable. It's generally going to be cash into the deal from the grant provider, and there is no repayment to it. When you have a forgivable loan, there are generally terms to that forgiveness. In other words, you might have to live in the home for 5 years or 10 years, or you might have to live in the home and be current on all of your taxes and insurance, or complete another education course. There are different types of terms that you can complete that would complete your forgiveness obligation. And the other thing to think about in a forgivable loan is that if you don't complete that timeline or those additional terms, and if you refinance or sell the home, generally if it's a cash out refinance during that term period, then this loan would be repaid, whatever the balance is at that time. So it is forgivable, but it is also repayable under certain circumstances. A deferred loan, the next one there, the purple column, is a loan that does not have payments to it, but it will be repaid at some point in time. So it will be repaid at the end of the term, or it will be repaid again if there's a sale or generally a cash out refinance. And some deferred loans require any refinance, would trigger the deferment to be paid off at that time. The orange category there, a repayable loan, generally as down payment assistance, means that it's going to be an affordable repayable loan. So for a second mortgage, there's a standard of saying 2% over the first mortgage interest rate is still in the affordable category. And sometimes these repayable loans have the same interest rate of the first mortgage, maybe slightly less than 2% over, and maybe sometimes under the rate of the first mortgage. Those are all different versions of interest that are being charged. It's otherwise a standard second mortgage, has repayment or payments to it on a monthly basis. But because it has a lower interest rate, it is affordable and it's helping to cover that gap of potentially financing 100% loan to value with no down payment required on a repayable loan. There are things like 80/20s that we've seen in the past. And even these days, you can get a 97.3. So a 97% first mortgage, a 3% affordable second. And that means that you've covered 100% of the purchase price. And then you only need to cover your closing costs and moving costs, etc. So there's a repayable loan. It is what it sounds like. The match savings is again what it sounds like. It is meant to incentivize savings. Generally, these programs require that you save over time. So it may be a period of 3 months or 6 months or more. You have to see what the individual program requirements are. Some of them will match based on your source, just seeing that you've had that in your savings account for at least 90 days. They'll match based on that. And these can be a 2-to-1 match or a 3-to-1 match. My favorite one's called Wish from the Federal Home Loan Bank. And it's a 3-to-1 match. So if you came in with $5,000, Wish will match up to $15,000. So it turns your $5,000 savings into $20,000 towards your home purchase. And that's a great example of a match savings program. Federal Home Loan Bank programs are available through member banks throughout the country. So that's a product that is available throughout the country at different member banks. The last one here is the self-help type program. Habitat for Humanity is the widest, most prolific example of these programs, but they are generally where you are putting sweat equity into building a home. You are part of the building of that the home or the remodeling or refurbishing of a home. You take part in that and therefore build sweat equity. And these programs also often have loans attached to cover whatever the sweat equity can't. And so in the case of a habitat, for instance, they would have a low interest, sometimes a 0% interest mortgage that is attached to that, that is repaid over time and is done at an affordable amount that's calculated ahead of time, very similar to how we calculate mortgage qualifications. But those are all of the different types of down payment assistance that are out there and that you can find on the Ready Own app that I'm going to demo for you in a moment. We wanted to reiterate, why down payment assistance matters, and this and sort of why we care about it. HCA is always focused on reducing the barriers to home ownership. We do a lot of infrastructure building within the industry. We're mostly a B2B nonprofit as a national organization, but we have built consumer-facing technology like ReadyOwn that can assist you, and it helps you find all of the different providers out there. Not only we're not seeking you to come to HCA per se, but we're showing you how you can get to all the different resources and resource providers localized for your area in the search. That's all to reduce these barriers to home ownership, getting you to assistance to reduce the down payment barrier, getting you to HUD housing counselors to help you plan, maybe improve your credit, maybe achieve your savings goals with some support, helping you with self-service sort of tools, so learning tools to help you prepare, and then finding the lenders and the providers that can actually help you apply for these programs and pre-qualify. That's all to reduce these barriers to home ownership. We're helping you qualify as well when we have down payment assistance. So just as I mentioned before, normally you'd have a 3% minimum down payment required. That sometimes can be covered by down payment assistance. Certainly in the case of, for instance, an FHA loan with a 3.5% down payment requirement, that 3.5% could come from a grant source, or it could come from a deferred approved source for FHA. So down payment assistance can actually cover the down payment that would normally be required for the borrower. And most of these programs will say that it's down to a $500 minimum borrower contribution. So in some cases, down payment assistance also covers closing costs. And those are cases where if you do the research, stack the programs, get everything you qualify for, you actually can get in with as little as $500 down, because the programs are covering both your down payment and your closing costs. And so that can reduce the amount of savings that you need in all the categories that Amy went over earlier, because we're generally focused on the down payment and the closing costs with DPA. Next slide. So I think we're going to jump into, we're going to go over some myths, I think, the common myths there. So a few common myths to just dispel about down payment assistance too, because people will say this. Maybe if you talk to a realtor or a friend or someone and you say, "Oh, I'm looking into down payment assistance," they might say some of these things. Well, only first-time home buyers qualify. Well, that is by and large true for a majority of programs, though there's some things for you to know. First-time home buyer means that you haven't owned a home in the last 3 years. So doesn't mean that you've never owned a home. It means that you've not owned one in the last 3 years. Also, if you've gone through a divorce or a relocation through the military, that can re-qualify you as a first-time home buyer. So there are ways of overcoming even the first-time home buyer requirement that most programs do require, but it's reset if you haven't owned in a few years. The income needs to be extremely low. First of all, extremely low. There are very few programs that even apply to extremely low. That would be 60% of the median income. Low income is generally starts at 80% of your area median income. And there are a lot of programs that are for 80% area median income or less, but that's not the majority of programs. So it turns out that more than half of the programs that are out there do not have that low income requirement and are more targeted to the median income or slightly above median income in that area. All of that information can be found in the program listings, and you can see that on the web pages. And then when you work with a qualified lender who's approved these programs and a lender who understands and knows down payment assistance, they will help you to see if you qualify for those programs, tell you what income level you're at and how that compares with these charts and what you might qualify for. So do the research and then get together with a professional who knows what they're doing. And again, the app will help you do both of those things, and we'll show you that. Also, that the process can be too complicated. Well, it's not too complicated when you're working with a loan officer. The loan officer is how you get your mortgage, right? It's who's going to coordinate the first mortgage, but they also help you with down payment assistance. So they'll also layer the transaction, work with those third-party programs, help you navigate them, and help you understand if you qualify for them. So they're your resource to go to. You can also go directly to the program providers, and in many cases, a housing counseling organization or a housing counselor will also be able to pre-qualify you for these programs if you're not sure that you are qualified for them. Then lastly, there aren't any programs in my area. This is a great chance to move to the app, and I'm going to demonstrate for you how to find the programs in your area. So this web app, or the web application, is available on readyown.app. You can also go to readyown.org. And this is a free service provided by Homeownership Council of America. There's no sign up required. There's no sharing of personal information required. You don't have to make an account. What we have done is fully democratized and made this information available at your fingertips. So the main sort of point of the site is to help you find down payment assistance for yourself in any area of the country. So I'm going to go with, let's see, Duluth is just popping out in my head for some reason. Duluth, Minnesota. We're going to see, I like to do random locations when I do a search demo. So we're going to see that in Duluth and in Minnesota, we found 118 programs. By the way, if I were to take that out and just sort of show you high-low, all programs, oh, I'd have to reset this, sorry. All of the programs in the country that we have here, there's 3,714 and counting, and the team is always looking for more. There are more in our hoppers. So there's a great number and deal of resources out there for you. You can search by zip, by city, county, state. It's going to sort those results for you based on local results first, and then going out to your statewide results or national results. So any of the programs that you qualify for that would be available for your geography. Once you set up your geography, and let me pick another place. Why don't I do Macon, Georgia this time? And see 87 programs were found for Macon, Georgia. Once you've done that first result, you can tailor these results. So now we can sort them. Instead of being local first, we can make them the largest programs first. We can also sort them by, as I was just describing to you, grant versus deferred or repayable. So by assistance type. We can show all types if you want to see all programs. That first-time homebuyer requirement, we can filter down to that, or we can make sure it's not there. We can look and see if there's a first-generation homebuyer program, or maybe a program for veterans. Those are all filters you can apply. And then finally, if you're in a transaction now, it may be important to know that funding is available today. But oftentimes people are working on homeownership for 6 months or more. So you'll want to see about the programs that are available. May not have funding today, but they might have funding when you are ready. And so it's worth you knowing about them, getting them on your radar as you prepare. When you're looking at programs, you can compare them side by side so that you can get a quick view of which different requirements the different programs have. You can also visit the page of the provider, so we're transparent on that for all of the programs. And then when you're looking at a program in detail, you can read about the program, you can see if it has income limits, and we suggest that you speak with a loan officer and understand where your income is so that that's not miscalculated, and see if you qualify, but this will tell you if it has a limit or not. We also tell you if funding is available and give you all the program requirements and details down below. And then you can visit the website and you can email this result to yourself if you want to save that. You can also email all of your search results to yourself if you'd like those to be saved. So that's the main search of DPA program search on ReadyOwn. I'm going to show you two other areas, one that's coming soon and one that's available right now. The coming soon, we're going to release next month for lenders to begin. This will be populated and available and really useful to consumers within about a quarter after that. We want to make sure that we have lots and lots of resources in here before we release them. But you will be able to find down payment assistance approved lenders. So we have a whole lender directory here that will link the down payment assistance programs to the lenders that have approved those programs. And that's really important because not every lender will approve a DPA program on the spot as you need it. And in fact, very few do that. And so it's important up front, if you want to talk to a loan officer who knows what the program parameters are and requirements are to see if you qualify, that you go to a lender who's approved the program. And then they're going to be versed on that product, and the loan officer will be able to help you. And so that's why we wanted to put this together so that we can connect the dots for consumers and you can see that a lender has approved a program and therefore go visit that lender and speak with a loan officer to see if you qualify. You can also go directly to the program provider, which are all found directly in the DPA search itself. The last thing to show you on ReadyOwn.app is the Mortgage Readiness Center. So this is a really useful area for consumers. And right off the bat, we have our home buyer checklist. So this is a great review, and I'm going to take a little bit of time, Amy, because I think we've got it, to go over these readiness sections. So we want to make sure that we've checked all three of our credit bureaus to make sure that they're accurate. They're also going to let you know what your score is, right? So you can find out what your mid score is. That's the one that lenders will use. That's the mid score of the three bureaus. You also want to make sure that there are no errors on your credit report because those could be pulling your score down, and that you've avoided opening new accounts in the last 12 months because that will actually affect your score and lower it. And then finally, and these are three big areas, but there are more that a credit counselor or housing counselor could go over with you. But these are three big behaviors you can control. You want to pay down your balances to below 30% utilization. So that means that you're not using more than 30% of the available credit, let's say on a credit card. Or on a car loan, if you can get that paid down to 30% of your original balance, then that gives it the most boost it can have for your score, in addition to you having consistent on-time payments. But we do that, this section will complete our credit and finances. For income and employment, and these are the basics, by the way, y'all, for mortgage readiness. So if you can get through these, then you're going to be mortgage ready. You want to have at least 2 years of stable employment. So we need to have, and if you've changed jobs, that's okay. If it's in the same sector or the same type of work, then it makes sense. You can document that, and you can use the 2-year history, even if it's with two different companies, but doing the same job. So we have a 2-year stable employment history. We've gathered our recent pay stubs, so it's at least the last 30 days. So if you get paid weekly, it's 4 pay stubs. If it's biweekly, it's 2. If it's monthly, it's 1. But at least cover 30 days of pay stubs. And if you get paid monthly, you might want to collect 2 months, would be a good idea. You want to have 2 years of tax returns completed and ready to share. Don't be late on that. If you are, get it done. And then always take a look and calculate your gross monthly income. It's important to learn to do this for yourself, for your own habits. And if you have trouble doing this, talk to a housing counselor or a loan officer and take a look at that. The gross monthly income is before taxes have been taken out, before any deductions have been taken out. It's the top line salary that you were signing on to for your job, right? Before all of the deductions in your payroll and on your paycheck. That's your gross income. Why do we use that? Because that's what's used in lending. And the reason we use gross income is because your taxation and your tax liable net income changes when you're a homeowner. So it's going to be different. And so all the rules are built on gross. Here's your savings and down payment area that I hope makes America Saves proud. But we want to determine how much you need for down payment and closing costs. And as Amy was saying earlier, you also want to think about moving expenses and any other purchases or upgrades that you might want to make to the home once you're in it. Have 2 to 3 months of bank statements ready. That's going to be basic minimum documentation that you'll need to share with your lender. So have that ready in a PDF saved on your computer. If you have multiple bank accounts that you've got to document, then you've got to do multiple bank accounts, have 2 to 3 months of statements all saved and ready for each of your accounts that you're going to be putting on your loan application. If you are getting any gift funds from a family member, or maybe you're getting a grant program, right, from down payment assistance, those down payment assistance programs will have a documented grant letter for you and for the file and for the lender. But if you've got any gift funds coming from a family member, be ready to document that with your lender. It generally takes a letter from whoever's providing it saying that that is a gift to you and then not repayable. Also, you want to research your down payment assistance programs. Make sure you've maximized your purchase power. Make sure you're not leaving money on the table. The research shows that millions of people don't know that they qualify for DPA, and sometimes, we see that about 150,000 folks fall out of escrow each year out of their transaction where down payment assistance would have helped them stay in. So you don't want to leave that money on the table or lose out on your purchase. And then finally, you want to make sure you still have emergency funds for after the purchase. This was on Amy's list. Make sure that you aren't tapping 100% of your cash so that you can get in the door because emergencies do happen. So you need to be prepared for them. All right, into the debt and budget section, you want to understand what your debt to income ratio is. And by the way, that's based on your gross income. Your debt to income ratio as a renter will be all of your consumer debts. So your debt payments on credit cards, on a car payment or student loan. It is not your utilities, though. It's not your cell phone bill or your electric bill, for instance. It's only debts that you owe and are making payments on. That's the debt that gets included, and it's calculated or divided against your gross monthly income. And that gives you a debt to income ratio on a monthly basis. So understanding that, again, work with a housing counselor if you can understand that, or if you don't, and or read and use online resources to practice. We've got some right here in ReadyOwn. You also want to avoid major purchases. Like when you're going into purchase a home, you do not want to buy a car. Do not buy your appliances or furniture while you are in the transaction. There have been many, many people who have had to cancel their transaction because they went and made purchases for the home that they hadn't quite closed on yet, and it ruined their credit and it ruined their debt to income ratio. And that meant that the lender couldn't close on the loan when it came time for closing day. So you avoid those things. They make major shifts to your credit and they make major shifts to your plan. Finally, create a post-purchase monthly budget. So when you're going to buy a home, you want to take a look at what that mortgage payment's going to be and make a budget based on that so that you know you're comfortable. That's where you might not want to go to the full 43% allowed debt to income ratio for mortgage. You might want to be at 40%, for instance, because that is more comfortable for you. All right, we've completed debt and budget. By the way, we're earning little badges up here, and we're at 74% towards our rating, so we are almost ready for a mortgage. Here are two other sections that we also suggest. You can complete a HUD-approved home buyer education course. There are multiple online options, and there are in-person options throughout the country to attend home buyer education. You're going to learn about the entire process, all the players, how you qualify, what different products and programs there are out there. All of that is part of homebuyer education. Get a pre-approval from a mortgage lender. So get pre-approved from multiple lenders. We actually recommend that you shop with multiple lenders and see what you qualify for, see what they offer you for each one. You'll want to get that pre-approval letter, though, before you go shopping for a home. And then finally, understand the differences between the different types of loans that you also get in education and counseling. And when you're working with a good loan officer, they will explain all of those different options to you. And it's a required part of the process that they'll disclose to you. If we've done that, gosh, we're at 87%. Final things on here are understanding the different types of property for DPA. This mainly is about that DPA programs often do not apply for a rental property. So this needs to be an owner-occupied single-family residence that will work for condos, though, as well. Then make sure that you're getting a home inspection as you go through your purchase. This is how you don't buy trouble, as we like to say, but you'll see things that are hidden, unseen, unknown about the property that could be major expenses for you after getting into the home. A home inspection up front and during the process can make sure you know what you're buying and that you're avoiding some major expenses that could be there and unseen. And then finally, understand the closing process and timeline that you also do in home buyer education. If you've done all these things, you are 100% mortgage ready. We recommend you contact a mortgage loan officer or a HUD-approved housing counselor to get ready for your next step. All right, a little bit of time left. I'm going to show you some more resources in the Mortgage Readiness Center. That was the checklist. Here is an affordability calculator that starts with what you make for your household. Again, you want to use your gross income and you want to use it for both or all adults in the house that will be purchasing the home, if there are more than one. You want to put in your monthly debts. We talked about that earlier, what gets included in your debt to income ratio. We will estimate here the homeowner's insurance. And then based on the state you're buying in, we've got estimates on the taxes for that area. We have a 43% debt to income ratio built in, which is standard for mortgages. And we're pulling today's average 30-year fixed interest rate to populate the rate and make this calculation. This is based on a 3% more down payment, so 3% of the purchase price as your down payment. And it breaks it all down for you just below, but it gives you an actual estimated purchase price. So a household earning $100,000 a year with average monthly debts can afford a home that's about $420,000 in cost. That would mean that you would need to have about $12,000 saved up for your down payment and closing costs. So there's a really useful calculator that works with what you know. Here's that type of assistance chart that we shared earlier. If you're looking for a HUD housing counseling organization in your area, you can pop in your zip code here to the Find HUD Housing Counseling. You'll see all the different programs that are there in your area. You can also sort by language, and you can click on them to go straight to their website or to call them and make an appointment or sign up for class. We have a full FAQ section in here that explains ReadyOwn, how it works, that we're not a lender, that we're really just providing you information, but also that we provide our search results based on where you are and what the filters are, not based on who's paid to be in the system or platform. So this is a really focused on consumers having access to information that they should. And then finally, we have a full glossary. So this can be handy. You whip this out on your phone when someone's having a conversation, or your realtor, or your in-home buyer class, and you can look up the term and read about it and see what that means. But that is a glossary to help you along. And that, my friends, is the ReadyOwn.app site.
All right, there I am. I hope. Can everybody see and hear me now? Gabe, that was wonderful. That was great. And I truly hope that it gave everyone, a better understanding of not only what down payment assistance is, but also how easy it can be to start exploring programs and resources that may be available to you. And I truly hope our America Saves truly hopes that, attendees leave today realizing that home ownership may not be as far away as it can sometimes feel. And that there are practical steps and tools and resources available, and I want to remind everybody that just taking that first step matters. And so we do have some time for some Q&A. So if you have some questions, please drop them in the Q&A and we will get to them. I see a couple already. And so Gabe, if you're up for a couple questions.
Of course.
Two questions that are in here to start with. One, and we won't say names, we'll keep these anonymous, but the first one says, you mentioned don't make any large purchases a year before, like a car loan. Does co-signing for someone, does it matter, or is it the same thing?
Yes, it does matter. It's going to show up on your credit report, and it will show up in your debt to income ratio when you co-sign for a car loan. So that is one of the I'm glad someone asked about that, because that is one of the most common things that happens, where people will go to apply for a loan and they'll say, "Oh, no, no, that's not my debt. I just co-signed on that." Well, if you co-signed, you are the co-borrower to that debt. That's what that means. And co-borrowers do show the debt on their credit report. They show the payment history. It is just as if it's your loan and your loan alone. If the other person were to get hit by a bus, as we like to say, it would be your loan alone. So it would be your obligation wholly. And so that's why the payment gets counted. The only way around that, and I do know a way around it, is if you're in that situation and you need to overcome it, is that you've got to work with a lender who can document this and remove it from your debt to income ratio. And that would be to document 12 months or more, and they may require 24 months of payment history that is made by the person who you did that for. So if you were the co-signer for a family member, let's say your brother, and you say, no, my brother makes that payment. I never make that payment. It's not my obligation. Then you can, it is your obligation. I want to remind you legally, but you can document that you don't make the payment and therefore argue to an underwriter for it to be removed from your debt to income ratio. And generally, like I said, it's going to take 12 months or 24 months of showing literally the canceled checks, the payment history coming from that other party. That's the level of documentation there in order to get that out from under your debt to income ratio.
Yeah, I'm glad that you finished with that because I was going to say you can petition, but it is a tough process. They don't like to do it because, like you said, legally you are responsible. And in my time as a lender, I've seen deals fall through because someone co-signed for a car and thought it wouldn't matter. So one takeaway today is that it does include co-signing. So good question. Good question. All right, I have one here, another one. How does private mortgage insurance play into all this when a person is using DPA and only aiming for the 3% down payment? Let me read that again. You got it?
Yeah, no, I got it. It's the generally the concept. Let's just deal with private mortgage insurance is applied to a loan when your loan to value is over 80%. Okay. So in these cases where we're talking about a 97%, loan to value first mortgage and a 3% down payment, whether that's down payment assistance or your money, doesn't really matter. Those higher loan to value loans include mortgage insurance. Sometimes they are paid by the lender. So there are programs out there where that is a fee that's paid by the lender, which can be huge because that can save you hundreds of dollars a month in your payment, allowing you to qualify for more mortgage, more loan, because it's a cost of the loan that limits how much you qualify for as well, because it must be included in your ratios. And so it matters. Also, having good credit matters with mortgage insurance. So if you have a higher FICO score versus a lower FICO score, you will have a higher payment on mortgage insurance calculated for the lower credit score, and you'll have a lower payment for the higher credit score. So, and that rings true with a mortgage in general. If you have a higher credit score, you are less risky as lenders look at it, and that includes mortgage insurance, and therefore you pay less interest. So your interest rate is lower when you have a higher credit score. So it's really important to focus on your credit score. You want that to be 680 or better when you're approaching home ownership. And really, you should know that most borrowers are 700 or better. So, as close as you can be to 700 or more. Once you hit the 700 mark or better, you're in the A frame. You're good. You're
Mhm.
good to go. So, and as long as you've hit 680, you're workable. You really are. So, and if you're just below 680, give it a little bit of time. Chances are
Mhm.
a few tricks, a few corrections, a little bit of payment, getting down to that 30%, and boom,
Mhm.
your score will be where it needs to be.
This was a great question. I love you where you went with it. I wanted to say that, this is very important. We're going to talk about this on the podcast this month. So you guys tune in, it'll be released soon. We have FICO on talking about the importance of your credit score, your FICO score, and how it is best to go into housing with the highest score that you can. Because when you think of housing, these are typically 30-year loans and that you're locked in based on that rate unless you refi. So you want to go in with that best score, right? The best score from the beginning to get that best rate that you can. So tune into the podcast to hear from FICO themselves once it's released this month, to talk about increasing your score and what scores are, that mortgage lenders look at. So, all right, we have a couple more minutes for some questions. And this is a good one. It says, what should I do after finding a program that look, and they're talking about a down payment assistance program. What should I do after finding a program that looks like a good fit?
So contact the program provider if you're looking on Ready On right now and find out
Mhm.
who their approved lenders are or how you get started in their process. So click right on through to the program provider page and go through their intake. That's the shortest path right now. As we open up the lender listings, which will happen later this summer, then you could also go to any of the lenders who approved the program and ask for a loan officer there who knows the program and can pre-qualify you for it because they, as a lender, have already considered it. They know how they would work with it. It's in their systems.
Perfect. And that answers one of the other questions that we had was, how do I know if I qualify? So basically, you have to see what those qualifications are. He kind of already answered that one. But our credit conversation, we'll take one more. Our credit conversation triggered this question, and you mentioned this on your Ready On uh, demo about credit pulls and shopping other lenders. They say, there's a myth out there. They've always heard that you don't want a lot of lenders pulling your credit, that it can hurt us. So, can you dispel that myth for us
Yeah.
about when you're shopping for a mortgage?
Yes, and this is a great one for your upcoming webinar with FICO. You are given a period of time that you can have multiple pulls that are the same type, and they are not considered detrimental to your score. They don't lower your score. What the system or the algorithm is seeing is that you are shopping different lenders with the same type of loan that you're applying for. And so it is not that you're getting multiple loans, it's that you are shopping different examples. And that's the difference, is that when you are asking for credit or applying for credit, let's say you were to apply for a new home loan every 6 months. That's going to lower your score. It looks like sort of the algorithm or the thinking is, why do you continue to seek additional debt? Right? And that's not a behavior that boosts your score. It's one that can lower your score. And so, yeah, you are allowed to have multiple pulls. And Amy, I can't remember if it's 90 days or 120 days. So this is a good question to bring over to your FICO, unless you know it.
I believe it's 90, but don't quote me on that. So
Okay.
we will clarify that.
Right.
We will. All right. Well, these have been some really great questions. There are no more in the Q&A right now. And so we are going to end the questions, but I want to again thank everyone for coming and joining us today. Gabe, thank you so much for being here with us and sharing all of your wonderful knowledge with us. And to our attendees, I thank you all for joining us and for spending part of your day with us. We encourage everyone to continue building those healthy savings habits, explore the resources available through Ready On and HCA, and then just take that next step towards your housing goals wherever you are in the process. We are here cheering you on. And thank you again. We'll call it a day. Y'all have a great afternoon.